Welcome to the Think Generation Wealth Podcast, episode number 87. And I am your host, Amir Estimo. Thank you for tuning in to the podcast. As I always like to open up with gratitude. I appreciate anybody that takes the time to listen to this podcast because you could be doing anything in this world, but the fact that you're taking the time to listen to this podcast is much appreciated. So thank you for anybody that even shares this content or even has somebody that any of my episodes that could be of value to someone. I appreciate it. If you can do your boy a favor, rate and review the podcast. It'll give it more exposure to people so they can be able to find the content. Also rate and review, leave a review, share the podcast. I would like to know how I'm doing. What can I improve on? What would you like to hear more of? So I appreciate it very much. Whether it's good or bad, it's only going to make me better. Okay. Now let's jump into the episode. For this month, the month of September, this is Life Insurance Awareness Month. So every year, we like to bring awareness to life insurance. And I know it's a topic that not a lot of people like to talk about because what life insurance basically says is, hey, there's going to be a time on this earth I am no longer going to exist. And that's true. None of us here are making it out of this alive. So while you're here, it's probably the best to maximize your life as much as possible because we have a short amount of time we live on this planet. And that's just the reality of it. So life insurance, I think, for me, the question I like to ask today is, do you think life insurance is an investment? If so, why? Ask yourself that question. Now, I'm going to dive in a little bit into this topic today because I feel like for me, now I'll open up and say this. I am not a financial advisor. This is only for educational purposes. So please, anything you hear on this podcast, I am not advising you. I'm not an advisor. So please find a financial advisor that can help educate you even more than what you're learning here or even here on this podcast. So let me start with that. And the reason why I'm asking this question, because I have life insurance. I've had it probably for the past, maybe I want to say 4 years, 5 years, something to that nature. And I usually get statements I have both term and a permanent life insurance. And I was happened to look at my statements, most recent, even the first or second time I've got it. And it started to lead me to believe, I'm like, when I got this permanent life insurance, now I'm going to go into what's the difference. So let's start with that. You heard me mention term and you heard me mention permanent. So term insurance is what it is. It's term insurance. So let's say, for example, you are 30 years old, you have kids, you just had kids, you just bought a house. You want to get life insurance because it's said that when you're that young, unless you fell into some money, more than likely you don't have a high you don't have a high net worth right now. So while you're young, it's probably best to get life insurance because it's much cheaper, you're in better health, etc. Right? But let's say your kids, you have kids, obviously they're depending on you. So you want to be able to get life insurance. So for a little cost, sometimes as low as 10, 15, even $20 a month, you can get pretty decent life insurance coverage. Now for that money, I don't know if you'll get $1 million policy or anything to that nature, but you can get yourself something pretty decent. So what my understanding is, life insurance, obviously you have people that depend on you. So you want to be able to get life insurance, right? But let's say you get a 20-year term. When you hit 50, that term expires. So you no longer have life insurance. But let's say you want to get another term insurance again. It's actually more expensive because actually the older you are, you probably present with more health challenges. So it's going to cost the insurance company more to cover you. Okay. Now, permanent life insurance is what it is, permanent. Now, you can get a permanent life insurance that actually can cover you for your whole life until you pass away. Then there's actually permanent life insurance As long as you pay the premiums, it will cover you. The difference is that a policy and a permanent life insurance is probably not going to be as high unless you're paying an exuberant amount of money, because the fact that the permanent life insurance, you have your death benefit and then you have your cash value. So it's actually supposed to be, looks like a savings type of thing. Cost the insurance company more money to cover you versus a term insurance, because eventually that's just going to run out. And then, so there's a two difference. One, you can actually, the death benefit probably is not going to be as high, but there's a cash value benefit to it. Versus a term insurance, there's no cash value benefit to it. It just exists until the day you pass away. That's basically, or let's say it expires. If you get a term insurance for 20 years, when that 20 years hits, you no longer have insurance. Okay? So those are the two. Now, for me, life insurance is not an investment, depending on who you talk to. Now, you may talk to someone else and they'll tell you, yes, it is an investment. But in my opinion, this is my opinion. Don't hold me to it, folks. My opinion is that I don't think life insurance should not be structured to where it looks like it's a it's a investment. It's really not an investment. Life insurance is actually a tax shelter. Now, when I say life insurance, I'm talking about permanent. Let's make sure I don't want to interchange those two words. So actually throughout the episode, what I'll do is I'll say either permanent or term. Now, permanent life insurance, let's say I'll give you two scenarios. I already gave you scenario one, 30, kids, married, bought a home. You want to get term insurance. It's very imperative you get term insurance, okay? You should have life insurance because that will actually give you time while you're building wealth. This is a Think Generational Wealth podcast. While you're building wealth, it gives you that time frame to say, okay, this is in case something happens to me. Maybe I don't have $1 million in the bank account, but at least something happened to me. My family will get $1 million. Okay, my kids will be able to go to college, paid for, etc. Okay. Now, the second scenario why someone would want to get permanent life insurance would be to lower your tax. So let's say someone you're high net worth. So you're going to be in a different bracket when it comes to permanent insurance, right? When it comes to what they take out of your taxes and whatnot. It's a good way to put your tax saving. You could put it, it's a tax shelter. It's a tax shelter that you can put your money in. Now, the downside to that is it gets to a point, there's only a certain max you can fund that permanent life insurance before, or let's say you go above that. There's a name for it. I don't want to get too technical on this podcast. I want to keep this probably as elementary as possible. And anything else after that, I would say talk to a financial advisor, someone who you know or may not know, or someone that you mean refer to who's going to put your best interest first. Okay, so you want to keep that in mind. You're looking for a financial advisor. Look for if someone comes in and tells you, man, this life insurance policy is an investment, I would say be cautious of hearing the word investment because it's a tax shelter. So for example, if you put, you have your death benefit, probably is going to be $130 or something $1,000, right? And then you max fund that policy every single year for the next maybe 20 years or so. You may end up having, between dividends and interest, you may end up getting, whatever you put into that policy, your cash value can actually it should exceed your death benefit. Now, there's some permanent life insurance policies, whole life and all those. Index Universal Life is one I'm a little bit aware of. What I know it does is that it hedges against, so it basically mimics the S&P. So if the S&P is up, your your permanent life insurance, the IUL, is going to be up. But there's actually a floor and a cap. So what's the difference? The floor, so let's say right now with the market not doing well last couple of years, you actually, if you go look at your 401k, your stocks or all that, all are down. Okay, so you probably lost anywhere between 20 to 30%, half or even more in some people's certain situations, right? So what the floor does is it doesn't, with the IUL, it doesn't allow you. Now, I won't say just the IUL, it could be different variety of life insurance that does this. But what the IUL does is that you don't lose money. So there's a floor, which was 0%. Sometimes it could be, it shouldn't be any less than 0%. The cap is though, let's say the market goes on an upswing, and let's say the market performs well and you gain 30%, right? On the IUL, there's a cap. So it could be 13%. So you're missing out on that 17% difference. Okay. Keep that in mind. Again, that's where you kind of want to start thinking and say, okay, if I'm missing on that 17% difference and the market goes up, the market goes down, let's say someone who has wealth, I think a permanent life insurance is probably something I would recommend to them, because you won't lose when the market does bad. You don't, you have that floor, but the only issue is that the cap is that you may miss out on some of those money. Now, the thing about the permanent life insurance is much more expensive. Okay. And for someone who's probably just looking to build some cash value, and I'm talking about, if you're not max funding the policy, it's actually probably, you're not going to see the advantage of a permanent life insurance. Because let's say, for example, we're going to get into numbers now. Let's say, for example, you put in $100 a month. When you put in that $100 a month, there's cost of insurance. So you're actually not putting $100 a month into that cash value. You're actually putting in, maybe, depending how cost of insurance, because there's fees and then cost of insurance, that can get pretty expensive. Okay. So that $100 a month that you think you're putting into is actually maybe like $60 a month. So it's only $60 that's going to your cash value. And let's say, for example, let me give you an example of a whole life policy, right? This is the same insurance company, same person. Okay. So let's say this person puts in $9,370 annually into their cash value. Okay. So let's say after 5 years, this person has $19,880, because you got to think of inflation, you got to think of, cost of insurance and the fees. They would have paid a premium of $46,850 in premiums. Okay, so basically you're paying $9,370 annually, but after 5 years, your cash value is only $19,880. And you've paid $46,850 in premium. Now, let's say after 10 years, your cash value goes up. It's $65,630. You would have paid $93,700 in premiums. But might I tell you, let's say your death benefit is $200,000. So right now you have a total insurance or whatever, $65,630 after 10 years. So you would have $265,630. Remember the $200,000 death benefit. Okay. Now there's certain permanent life insurance policies that if you pass away, whatever's the greater. So if you have $200,000 in death benefit and $65,000 in cash value, guess what you'll get? You'll get the $200,000 in death benefit. But then there's some premiums where if you pay $200, 200. You have a $200,000 death benefit. You put in 200. You put that 65,630. You would actually get both of it. So whole life is more so whatever's a greater IUL, index universal life is you'll get both. Now it just depends on, again, that depends on the company and how it's structured. So now let's say after 20 years, you have a cash value of 181,630. You've paid a premium of $187,400. So if you were to do the math, right? Let's just do the math. For example, I want to do the math here. Let's say 187,400 minus 181,630. There's actually a $5,770 difference after 20 years. Now the question you should ask yourself is, okay, if I've paid 187,400 in premium, right? And then I built up a cash value of 181,630. So you're actually paying more in premiums versus what's actually in your cash value account, right? The question now, the difference is 5,770. 5,770. Your mind probably be like, well, what could have I done with that difference? That's where Dave Ramsey is a component of this, but he'll tell you buy term and invest the rest, right? But if you have that $5,770 difference, your mind is going to be, unless you're really looking at it, your mind is going to be, man, I could have probably took that difference in money, invested maybe into the stock market, real estate, whatever, and I probably would have got a higher return. Okay. And that's the question. That's the thing that I had to think about. I've been thinking about. And then on top of that, you have what they call a surrender charge. So if you decide to let this permanent policy lapse, it's not like the term insurance where you just don't pay, they cancel it, you get no insurance, right? But on the permanent insurance side of it, what you have to understand, there's something called the surrender cash value. So that means, and usually that could be depending how long that is, meaning that you have to keep this policy in place, because whatever money you put into this policy, you stop paying for it, whatnot, you will surrender your policy. You will surrender it, and they will literally take your money. So if you put in a $5,000, your surrender charge could be like $4,000, and you have lost $1,000. I mean, you have lost, you have lost $4,000. Sorry about that. You have lost $4,000. That's what you want to keep in mind. Unless you're someone, I believe, if you're someone of high net worth and you want to lower your tax, that's where a permanent insurance can come into place for you, right? But if you're like the regular person who's putting in maybe $70, $80, most financial advisors won't tell you this because it probably makes them more money. And they get paid really because they get usually a upfront cost, and then there's usually a back end cost. I mean, they get something like, let's say if they're making a commission of 70%, they may get 55%. The other 15% could be spread out, because the more, every time you pay into your policy, they get a residual income. Keep that in mind. Okay. So if you're going to go with that route, it's best for you to max fund that policy, because if you don't max fund that policy, you will not see the true value. And even me, I had to learn this. Like, I'm learning it now. I'm saying, man, I put it in this much, I have this much, and I'm looking at the numbers, and it's still not making sense. In my mind, I'm saying, man, I could probably just put this extra money into the stock market. What I got cash value in my permanent life insurance, I already got that in the stock market, believe it or not. So to me, it becomes a question of, okay, at the moment, I wasn't educated enough. I did not educate myself enough on the permanent life insurance. I knew a little bit about it, but I was not educated enough. Okay. And I'm not saying the person who set this up for me, sold me a lie. I'm not saying this at all. It just, I think for me is I should have probably went back and did my homework a little bit. And now I have to get into a situation to where, like, if you want to lower your tax bracket, again, this is another reason to have permanent life insurance. Maybe lowering your estate taxes too, because you don't get taxed on your dividends and interest, those until you take money out. Now, here's the thing about a permanent life insurance. You have the cash value. You can actually borrow against that cash value. But again, if you don't have a lot of money, it doesn't really make much sense. It doesn't, like, if you only have a couple of grand in there versus someone who may have, I don't know, they may have $200,000 in their cash value. That would probably make more sense because they can take that money and actually pay that money back. But the thing is, you want to keep in mind, if you take money out of that policy, you're lowering your death benefit. Now, you do pay yourself back, normally like a 401k. You pay yourself back, but you are not. You will lower your death benefit, your total, whatever that is. So if you decide, hey, I want to take this money out, maybe send my kids to college, or take this money out, buy a house, look into real estate, you can do that. But when you pay it back, you got to pay it back you pay yourself back with interest, one. And two, you actually lowering your death benefit. So if you took $100,000 out, and let's say you had $300,000 in there, you took $100,000, you're now left with $200,000. So if something happens to you, that's $200,000 that'll come, not $100,000, not the $300,000. So that's the thing you want to keep in mind. And I felt like I really wanted to talk about this on the podcast because I think for us who may have a job or who doesn't have the net worth yet, you want to sit down. Now, I think term insurance, the least you can do is get term insurance. But if you're getting into the whole permanent life insurance things, it's probably best to really educate yourself. Do not rely totally. Now, here's the thing. Now, I'll say this, and I want you to take this at heart. Do not rely on a financial advisor. Do your own research. But here's the thing. You don't want to be able to go and research, and you're researching 20, 30 different opinions, right? And now this is where you get the analysis paralysis. And now you're not taking any action because you're just like, man, I got, this person says this person says that. Amir says this, when Amir already told you he's not a financial advisor. This is just educational purposes, right? And you have to think for yourself, is this the best? Does this work for me? Because if I know I can't max fund this policy and see the best use for it, I don't know if it fits what I'm trying to do. That's what you want to ask yourself. And if a financial advisor comes to you and says, this is an investment, maybe that word investment needs to be elaborated a little bit more, because that can mean anything. That can mean, hey, that's an investment. What do it's probably an investment to you, but it's not to me, right? So you want to make sure, I would say step number 1, educate yourself. Step number 2, find a financial advisor that's looking out for your best interest, not their best interest. And their best interest is, hey, I'm going to set you up on whatever policy that can pay me the most money, not only in the short term, but in the long term too. Okay? So you want to keep that in mind. Step number 3, I would say, I'll probably put this is probably not any, but I would say, look at your situation. Before you make that decision, look at your situation. Does this fit your situation? Not only now, but in the long term. Because you got to think, the goal is we want to live as long as possible, right? None of us want to die early. I mean, none of us want to pass away. I mean, it's just reality of life. But the thing is that you want to know, is not only you're thinking for today, you're thinking for tomorrow, and you're thinking for years down the road. So I would say on the permanent insurance, life insurance, there's just a different level of thought process, different level of not only how does this work today, but tomorrow. Because you may turn around and it makes sounds all dandy and good until you get that first statement. Now you're questioning it, and that's what's happened to me. I actually sat down with my financial advisor, and then we talked about it. And the person was like, "Yeah, it's expensive." But I'm saying to myself, well, I'm putting in this money. So if I'm putting in, let's say, $1,000 a year, and really only maybe 400 going into the cash value policy, I'm not sure if this works, because that $1,000, I probably could have put it into some type of other investment, real estate, stock market. And probably a lot of people say right now is not the best to invest in the stock market, right? A lot of people say that. But what you want to consider is, how does this work for me in my journey, right? The journey of wealth. So that's the reason I recorded this episode today, because I really felt like there's a misconception of life insurance, that life insurance is a good investment. It's an investment when it's really not. It's a protection. And maybe term insurance might be an investment for you, because maybe if you pass away, your family doesn't have to struggle. You don't want to leave your family struggling. And that's the thing about it. That's the reason why life insurance, term insurance is important to have. That's the least you can do. Now, if you have an employer, they do offer life insurance, but it's not a lot of money. It's basically whatever your salary is, or sometimes even less than that. Whatever they got is what you can get. So please don't consider that, don't consider that a very good, like, yeah, I got insurance. No, you don't. Your job is not good. And here's another thing. Once you leave that 9 to 5, you lost that insurance. When you get your own outside insurance, term insurance, you don't lose that unless you don't pay for it. If you 30 years, if covered for 20 years, 20 years. That's just what it is, right? Unless you don't pay for it, or you go and do something totally stupid, like go commit murder or something to that nature, then you're going to lose that insurance. You're just going to, like, I think there's certain things that they will not, even in that scenario, I don't know. You may still, maybe as long as you pay for it, you may be fine. I'm not sure. So that one there, are probably not 100%, unless you're just doing something illegal or totally illegal, that the insurance company can contest and probably end up winning. We insure our cars, we insure our homes, but when we talk about our life, most of us don't do that because we don't want to deal with the inevitable. And it's eventually, unfortunately, none of us here are going to make it out alive. So it's imperative for you to have these things in place. So if something were to happen to you, whoever is the breadwinner of the family, your family is not struggling. They can have a life where they don't have to struggle. And that's the thing. That's what you want to leave. And that's what someone who's an adult, someone who's responsible, makes good decisions do. So you want to make sure that's part of your strategy. It shouldn't be the strategy, but part of your strategy of building wealth. Okay? Hopefully you found value of this episode. I really appreciate you taking the time to listen to this episode. Like I always say, I like to leave you guys with a quote. And the quote is, you can't always choose what happens to you, but you can always choose how you feel about it. Thank you. Much love. See you next week.